Hello and welcome to Equity Sahi Hai, an investor education initiative by Motilal Oswal Asset Management and the Money Mile. On this series, we talk about investing in equities through the mutual fund route. What do you need to keep in mind? How can you do it the best way that works for you? Joining me today is well-known certified financial planner Shweta Jain to discuss all that and more. Thanks very much, Shweta, for being here on Equity Sahi Hai.
My pleasure.
My first question, these are days when investors are beginning to feel that, as far as the mid-cap universe is concerned, that's seen a bit of a beating. While the Sensex is at an all-time high, but even there, it's only 4 or 5 companies which have really, propelled it to that level. People tend to get a little confused in moments like these, in times like these. What do you recommend to investors? What should they be doing if you're sitting on an equity portfolio through mutual funds?
So there are two things that investors can really do at these times. One is if they do have the liquidity, they should continue to invest. If they have SIPs running, they should continue to invest. Second thing is that people should always have slightly diversified portfolios, even within equity, large cap, mid cap, small cap also. So when they have diversified portfolios, it gives them an opportunity to kind of have a cushion even while being invested in equities. So while mid caps have seen a correction, large caps really haven't seen that much correction. So then their portfolio it doesn't really have a issue with the portfolio. So they should have a diversified portfolio. And like I said, when they see bigger corrections, if they have the liquidity, that is when they should continue to invest more.
Are you seeing a trend where people who are running SIPs are calling you and telling you, should I stop? Or do you think there's been a maturity that has come in over the last few years where people realize that cycles of markets will continue and I need to remain invested?
It's interesting because clients who have been investing for the last few years are now used to volatility. So they find times like these interesting and look forward to times like this because they know that this is when they can make money. So they invest and they don't stop their SIPs. But newer investors and especially investors who've only seen the past few months, 2017 mostly, they're in a little bit of a panic mode, especially if they've invested in mid and small cap because that's seen a lot of beating. But we try and tell investors to have a diversified portfolio. So first time investors definitely should start off with large cap or multi cap and not get swayed by just mid cap returns of mid cap portfolios. So they are trying to talk to us about how they can stop SIPs, but we are of course asking them to continue.
One of the ways in which you judge the performance of your mutual fund scheme is by the benchmark. Right? So people tend to say, oh, the Sensex has delivered this much. Why has my scheme not delivered this much? And I guess that's a very unfair comparison because a mutual fund scheme is probably investing in 50, 100 companies. And do you think that that's a fair way of looking at returns, or should you allow a scheme or look at the past track record of 5 years, 10 years? There are a lot of schemes which have done really well. So how as an investor should you be judging whether this scheme is doing well or not?
So as an investor, I think it's first important to understand ourselves, how we behave. We should continue to invest based on our goals. So I think the first benchmark that I would ask investors to look at is themselves. Are they saving enough towards their goals? Because that's the first checkpoint for them. Secondly, on well-performing schemes, I wouldn't recommend that investors change these schemes or track the best performing scheme and switch that every year, because if you see data, no particular scheme has been the best performer for the last 20 years. There's no particular scheme that will continuously be the best performer over the years. So having said that, benchmark is not really the best way to judge them, because also what happens is schemes don't really hug their benchmarks, because if they do, then there is no way that they'll create alpha over the Sensex. So if you want your schemes to outperform the Sensex, give it time, or the benchmark, give it time, and at times like these, give it more money, so invest more.
And the reverse also works, right? So if the market is down, you are obviously going to see a bit of negative returns, maybe for a small period of time, but that shouldn't become the cause for you to wanting to exit.
So equity investors should definitely not panic when it comes to negative returns. I think a lot of investors that we talk to now don't really panic when they see negative returns. They are in fact excited to invest more, but I think that's just one set of educated investors, because then they see the opportunity that they've been investing regularly. This is the time for them to capitalize. They're buying when markets are low. So they do appreciate that. So I don't think investors get in such a panic mode, at least not as of now.
Shweta, recently the market regulator SEBI brought about a lot of changes in the reclassification, so to speak, of the schemes. At an investor level, how should I look at these changes? Do they affect me? Do I need to get out of some schemes, get into some others? Or is it overall net, all right, I just continue the way I was?
As an investor, you should definitely look at your schemes. If your schemes have been telling something and doing something else, for example, if they've classified themselves as a pure large cap and they've been investing in mid and small cap, then that is something that would have changed right now. So if the schemes were doing what they were saying and they were sticking to their mandate, then you have, as an investor, have nothing to worry about. A lot of schemes have done changes in their portfolios in the last 6 months. So if we were to just see them by their track record previously, we may not be able to judge a scheme correctly today. So I would recommend that people now, investors especially, not see the past year's track record, but look at the mandate today that they have and their risk appetite and then invest.
Shweta, one of the questions we get most often is, should I be in a growth scheme, a growth option of a scheme, or should I be in a dividend plan option? And I think recently we saw some fund houses coming out with these monthly dividend plans. And while mutual funds aren't allowed to guarantee returns, but the perception was that I am going to get something every month. From an investor's, again, point of view, because this is not understood very well by a lot of investors, that unlike a stock or a share, which is giving you dividend from its earnings, a mutual fund is only returning your own money back to you as dividend. So it's not like it's some bonus that you're getting. It's your own money coming back to you, and then your NAV drops accordingly. Is that something you strongly vote against, the dividend plans?
Absolutely. In fact, when mutual fund schemes did start announcing monthly dividends, we were very wary because that is definitely not how you want to get in investors. And we've been recommending, and I've been recommending growth option for equity schemes for the longest time. Today, I can proudly say none of our investors have dividend options in their equity schemes. They're all growth option, for the simple reason we invest in equity for growth, for whatever requirement that people have, which they choose for monthly dividend. There are debt mutual funds available and they should stick to that. They should not come to equity for regular dividends. That's something that if we as advisors do recommend to them, we're doing a disservice to our investors.
And when you say growth, obviously one of the big benefits of equity is the power of compounding. So the minute you start taking money out, you're actually affecting that.
Absolutely. You're actually cutting down on your own investment very regularly, in fact, and then you're not giving your time to grow at all. So absolutely, your return on your investment will definitely get beaten.
Thank you, Shweta, for joining us on Equity Sahi.
My pleasure. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.